Greetings and welcome to the 2021 Carroll School webinars. I'm Andy Boynton, Dean of the Carroll School of Management at Boston College. Welcome to the final webinar in our three-part series titled Post-Pandemic Trajectories, Politics, the Economy, and Global Markets. Over the course of this past week, we've heard from prominent speakers about anticipated developments in domestic politics and the national economy in 2021. Today, to conclude our series, a panel of financial experts will discuss what lies ahead for investors in global markets. We're thrilled that moderating the conversation is Kate Rooney, CNBC tech reporter and a 2013 BC grad. Kate is joining us from the West Coast, where she covers financial technologies and venture capital for CNBC's San Francisco bureau. I would also like to extend a warm welcome to alums of Hamilton College who've signed on to see their former classmate, my friend, and one of today's expert panelists, Rich Bernstein.
Good morning and welcome to the third webinar in our series on post-pandemic trajectories. I'm Dan Holland, chairman of the advisory board for the Carroll School of Management and one of the co-chairs of this year's conference. I want to thank all of you for joining us for today's conversations about global markets. A lot has happened in the world since we convened last June, and earlier this week, we heard from Larry Sabato about the political policy implications of the pandemic, and from Fed President Rosengren on his views on inflation and monetary policy. This morning, we're going to focus on the pandemic's impact on global markets, and we have an outstanding panel of experts to share their perspective. Moderating the panel today is Kate Rooney. As Andy mentioned, many of you probably know her from watching CNBC, which is on all day in my office and on the trading floors around the world. In fact, she was just on a few moments ago talking about Cathie Wood's ARK Invest and the impact of tech stocks. As Andy mentioned, Kate's a technology reporter for CNBC based in San Francisco, focusing on all things related to fintech, payments, venture capital, and digital platforms. She provided excellent reporting during the GameStop, Robinhood, Reddit gamification of trading phenomena, and on many other cutting-edge topics. She joined CNBC in 2015 and was a producer for Squawk Box, the morning show where many of us start our day. Importantly, she's a BC grad where she studied communications here on the Heights and went on to earn her master's degree at Northwestern. Joining Kate is Rich Bernstein. Rich is a friend of Boston College and is a past participant in our finance conference. Rich is a 40-year veteran of global markets and following a long, successful career as chief investment strategist at Merrill Lynch, he founded Richard Bernstein Advisors in 2009, where he focuses his investing on macro trends. Rich was inducted into the Institutional Investor Hall of Fame, where he was a member of their All-America research team for decades. Rich is chair of the investment committee of the Alfred P. Sloan Foundation and is also on the investment committee of Hamilton College, his alma mater, where he's a trustee. Rich received his MBA in finance from NYU Stern. We also welcome Tony Pasquariello. Tony is a friend and colleague of mine from Goldman Sachs, where he is the global head of hedge fund coverage and is one of the true thought leaders in the industry when it comes to global macro. He routinely speaks with many of the smartest investors of the world and shares his views on markets and macro trends. He also leads our firm's cross-divisional coverage of family offices. Tony joined Goldman Sachs in 1999 in our Boston office, where we worked together in fixed income. Little known fact, Tony was enrolled at BC, taking classes towards his master's in finance degree, but was relocated by the firm to New York shortly after the start of the program and had to withdraw. Tony received his BA from Colby College, where he remains very involved. He serves on the Leadership Council of the Robinhood Foundation, is a trustee of the Taft School, and is vice chair of the Board of Trustees of the Uncommon Schools in New York City. Kate, Rich, and Tony, thank you for joining us today, and we look forward to hearing your thoughts on the markets. For our audience, if you have questions for our panelists, please submit them using the Q&A feature at the bottom of your screen. And with that, I'll turn it over to Kate.
Terrific, Dan. Thank you so much. I'm really honored to be here. A very proud Boston College alum and very excited for an interesting conversation with Tony and Rich. So thank you both for joining us today. We also, Dan, I know you mentioned tech stocks. I was on Squawk Box this morning talking about Elon Musk and Dogecoin, but we'll keep it a little higher level than that. I won't ask you guys to comment on Dogecoin. But I do want to start with sort of the topic on everybody's mind. The reason we're doing this virtually, the pandemic and the recovery, I think we'll sort of make that an overlying theme here. I do want to start though with the job numbers. We got April hiring out this morning, not exactly what we thought it would be. Expectations were for about 1 million new jobs. Instead, non-farm payrolls this morning came in at about 266,000. So way, way below expectations. Rich, maybe we'll start with you here. What's your take on that number? Does this change at all how you're thinking about the recovery post-pandemic?
Well, thanks, Kate. Good morning, everybody. No, I don't think so, Kate. I think that, look, I think what this number shows is how little we actually know about how the pandemic affects economic statistics. Notice I said statistics, I didn't even say the economy, because I think every reasonable person expects the economy to continue to strengthen over the next several months, if not next several quarters. And this number really shouldn't dissuade one from that. And if you triangulate today's number with some of the other data that has come out on the labor markets and that sort of thing, it really says that this number is a very odd number. You know, we've seen jobless claims. Yesterday, we saw jobless claims, a leading indicator of the economy, basically hit a cycle low, a post-pandemic low. We've seen in the NFIB survey of small businesses that they have a category that's called jobs hard to fill. Jobs hard to fill has been the highest ever in history. So I think today we probably want to fade today's number for maybe a statistical aberration. I don't really know. But I think if you look at the overall economy, you'd have to say we're still on a clear recovery, and we're not on an expansion path, but we're clearly on a recovery path.
Got it. And Tony, what about you? Does this signal anything as far as what you would tell clients, what you're seeing in your day-to-day at Goldman?
No, Kate, I think I share Rich's sentiment, and I think the word choice odd is the right one. So when we basically take out the seasonal adjustments, the payroll number would have been 1.1 million. The unemployment rate would be 0.5 point lower than it appears today. And so it's still a miss. It's certainly a disappointment in this kind of desire to be at full employment, but no, we don't think the reopening is off track. We don't think the economy's stalling. You look at the market's read of that, I think very consistent, right? So we've got S&P making a new all-time high. The bond market's rallied, so in turn, kind of the rate-sensitive parts of the equity market are leading the charts today, but very much a risk-on reflex through the eyes of stock operators.
Got it. And I've got to give a shout out to our headliner this week, Eric Rosengren, Boston Fed president. He seemed to say, I'm sort of paraphrasing here, but inflation right now is not an issue. He talked about inflation sort of staying close to 2% for the near term, accommodative monetary policy. Rich, back to you on this one. How are you thinking about inflation? Are there other things in the economy that are worrying you, aside from the jobs number, that might signal some sort of inflation here?
Well, I think, Kate, on the inflation front, I think people tend to think too much about the absolute rate of inflation. Is it going to be 4% or 5% or 6%? And I prefer to think of inflation as kind of an over-under bet. Is it going to be higher or lower than people expect? And I think the odds right now are mounting that inflation will be higher than people expect. Why do I say that? There's a lot of changes going on in the inflation backdrop, significant changes. Some of that is reflected in the labor statistics that came out this week and today, where you see kind of tight labor markets, perhaps. But things like, money growth. I mean, money growth is running at 25% a year now, which is by far and away the highest in my lifetime. Probably 2.5 times the norm. We're seeing the United States with our trade deficit now starting to import inflation. I'm sure a lot of you knew that, heard in one form or another, that it wasn't such a big deal that we had a trade deficit because import prices were rising more slowly than our normal CPI, headline consumer price index. Well, that's not true anymore. Now import prices are rising faster than the CPI. So there's lots of changes going on in the backdrop. Does that mean you're going to get 1970s type inflation? No, probably not. But could it be higher than people think? And a year from now, could people be surprised? Yes, I think there's a very high probability that could happen.
Got it. And Tony, what are you looking at in terms of signals of inflation, whether it's the labor market or some of these alternative data points? What are you thinking about that as a risk?
It's certainly a mosaic. And again, to Rich's point, we're living through this kind of extraordinary cycle. The Fed's worked very hard essentially to get out in front of what appears to be this kind of bulge above that 2% core inflation target. I think it's interesting. The $64,000 question for markets, Kate, is so much, I think, of this rally is predicated on the idea that the Fed can wait and they can be very behind the curve and very accommodating. The history books suggest normally what kills expansions and what kills bull markets is the Fed. Well, they've essentially said the era of preemptive tightening is over. And again, we're going to be late to the party. I think as the year rolls on, the big question becomes, does that bulge in core inflation stay or not? I think at some point, if it were to remain above 2%, the bond market may say to the Fed, hey, we know you think you're on hold for another 2 or 3 years, but we don't. And we're going to ask for a little bit more risk premium. And that's when things could get really interesting in the second half of this year.
Got it. Well, a big part of this economic recovery in the picture has been stimulus. So we've seen trillions of dollars pour into the economy, central bank easing. I'd love to get your take on how we unwind this. I ask myself this all the time. Anytime you see even threats of rising rates really seems to spook the markets. How do you guys think we get out of this cycle? How does this end? If any sign of inflation, rising rates really seems to freak out the markets and investors. Maybe Rich, we'll go back to you on this one.
So maybe it's not so much a freak out, and maybe we're starting to see that slowly already. I mean, you're a tech reporter, so I don't want to bash the tech sector.
They freak out about inflation.
That would be unkind. But I think it's not so much that the markets freak out. I think at our firm we view it more that there's a bifurcated market. We've got this market that's predicated on a slower economy, lower interest rates, very long duration equities, if you will. And that would be the whole innovation, disruption, technology sector. And then we have a set of the market that's really dependent on a stronger economy, rising rates, greater industrial production, that sort of thing. And so I like to think of it more as a seesaw than just the market. And I think the shock, if you will, if you want to use that word, the shock could be that over the next 6, 12, 18 months, that the seesaw is much more dramatic than people think, and that the kind of long duration equities don't do very well, and the more traditional, ugly, dirty cyclicals do. If Tony's right, and the bond market does start asking for a risk premium, those long duration equities could be at substantial risk.
And a follow up to you, Rich, on that, are you seeing with your clients sort of a rotation here of that reality that investors are potentially changing the way that they think about value and growth stocks versus some of the. I'm not sure I would say that there's a change, and here's the reason why. This is a little bit cute and a little snarky, I will readily admit, but I'm asked all the time, what inning are we in the cyclical rally? Right now, people ask that because they're very scared that they could be in the 9th inning and they move into cyclicals right at the time that they don't want to. I have never been asked, I don't know about Tony, but I have never been asked, what inning are we in for the tech sector? What inning are we in for innovation and disruption? Nobody has ever asked me that question. So I don't think that people have fully embraced this notion of cyclicality. I just don't think that's out there. Maybe Tony sees it differently, but that's kind of what we're experiencing. Tony, do you get that question about what inning are we in? And what about that rotation as well? What are you seeing from the Goldman side?
We certainly do. And this has been kind of one of certainly the questions of the past week, because you've had a very interesting set of price action. There's been a lot of pressure on those very long duration kind of highest, call it EV to sales names, think software, think internet, and then a very good kind of rally in cyclicals. I think if you take a step back, really in the post GFC period, if you think from, call it 2009 through 2019, all the rage was secular growth. There was an enormous amount of capital that flowed into secular growth. At times it felt like FANG, if you will, was the only game in town. That was unequivocally the right judgment. An enormous amount of compounding happened on top of that capital. So for all the right reasons, that was an incredibly powerful story. I think, even as recently as a year or two ago, if one were to suggest Now's time for value. Now's time to rotate some of your chips out of, call it tech, into banks or energy. You truly would be laughed out of the room. It wasn't really until the end of last year when it became clear we were going to have a Democratic administration. We're going to go very hard on the fiscal side, which they certainly have followed through on, and the breakthrough on vaccine. It wasn't until then that this kind of reflation impulse really, truly took hold. And in the 5 or 6 months that's followed, we certainly have had more people, again, work to shift some of those long-held structural positions in tech, in growth, into the more cyclical parts of the market. But I think in Rich's word choice, if we were to kind of use innings as the right measure, it still feels like it's very early innings to me.
Got it. And this leads us to a good discussion about valuation. So there was the Fed put out its semi-annual financial stability report. I'm quoting from it directly, but rising asset prices in the market and elsewhere, or the stock market and elsewhere, are posing increasing threats to the financial system. Rich, back to you on this. Do you agree with that? And what's your take on the current state of valuations?
So Kate, I wrote an op-ed in the Financial Times probably about a month ago now that talked about why this is happening. Why are we seeing these kind of financial bubble? I don't know if I want to call them bubbles, but why is there so much financial speculation going on? And part of the reason is that we're having an immense amount of monetary stimulus. I think everybody is aware of that. But what's odd and what's happened is the transmission mechanism of getting monetary policy into the real economy, as opposed to the financial economy, the real economy has broken down. And one of the reasons I would argue that has broken down has been the combination of a very flat yield curve. In other words, the spread between, say, 2-month or 3-month and 10-year, or 2-year and 10-year is relatively narrow. There's not a lot of steepness in the curve, and financial regulation preventing the banks from taking on more leverage than they might have. So what that means is it's basically less profitable for banks to lend. And what you're finding is that banks really aren't lending. That mechanism is broken down. So and this has given rise to things like private debt and all these other kind of non-regulated lending industries that take shape. But what's happened is that this huge monetary policy, I said about 25% M2 growth, is trapped. It can't get out into the real economy. So where does it go? It goes to all these kind of, companies that want to take people on vacation in outer space. I mean, all this weird stuff starts happening.
Tony, what's your take on where we are with valuations?
Stocks are expensive, Kate, on any historical measure. That's an inconvenient truth. And so I just looked this morning on kind of a next 12-month look, so a 1-year forward look. The S&P trades at 22 times, which is in the 95th percentile of history. I think only kind of during the tech bubble did you sustain a higher multiple. And so we're certainly on the rich side of fair at the very least. I think that has a lot to do. Again, a lot of that traces back to lower for longer and free money in the Fed. I think I always say when we engage with clients for shorter term investors, valuation is not something we would spend a lot of time on. It will not make you money trading tactically in the next week. It is a signpost for forward returns. And so do I think the market will be able to generate this kind of earning expansions going forward that we've seen over the past year or the past 10 years? No.
Got it. Well, we'll pivot here. I won't get us too deep into politics, but I do want to ask about tax increases. I'm sure our audience is curious about that as well. I know we're expecting a tax hike on capital gains, carried interest, estate taxes. What is the effect, if any, on capital formation? Will this cause any sort of slowdown? How are you thinking about tax hikes, Rich?
So a couple of things, Kate. One, I think it's pretty clear, judging by the budget deficit, that the government needs more revenue, right? We could argue about cutting spending as well. That's a different story, but we're focusing on taxes, so that's raising revenue. It's pretty clear we need revenue, right? I mean, let's be honest. We could argue about how much, what the sources are, or anything else, but with the budget deficit being as big as it is, it's kind of staring us all in the face that we need revenue. Number two is capital gains. Capital gains tax rate. Way back when I was at E.F. Hutton, for those of you who remember E.F. Hutton and that type of stuff, we did a study that looked at capital gains tax rates. And what we concluded from that study was that it wasn't necessarily the capital gains tax rate, but the difference between the capital gains tax rate and the income tax rate. And effectively, when they were the same, which happened earlier on, you dissuaded investors from taking longer term risk. And I think if you look at the United States right now, the last thing we want to do is dissuade people from taking longer term risk. You started out by talking about GameStop and things like that. We want people to take long term risk, not short term risk. So I'm not sure that maybe we want to raise the capital gains tax rate, maybe we don't. Not my job. But I think we want to keep some differentiation between the capital gains tax rate and the income tax rate. And then finally, will rise in the corporate tax rate kill this cyclical rally? I don't think so. The surge in earnings, by our estimation, is so huge as we go out 2021 to 2022 that it might curtail it a little bit, but it's not going to stop it. And then I'm not a tax expert, but my guess is that some of these cyclical companies may have tax loss carry forwards from the pandemic, which will alleviate some of the tax burden going forward, whereas some of the more profitable companies that didn't suffer don't have that advantage. So I don't know. I think it's a multifaceted question. I'm not sure it's going to kill the stock market, though.
Got it. And Tony, what are you hearing from your clients? I'm sure capital gains is top of mind for folks at Goldman.
It certainly is. So essentially the Biden administration, they've been very consistent about this since the end of last year. So kind of the period between, call it election day and inauguration day, where they essentially said, look, we want to take the corporate tax rate halfway back from where it was. So it went from 35 to 21. We want to get it back to 28. We want to take the top household bracket back up to 39.6. And then we want the capital gains tax to match that at 39.6. Where we think this ends up is more like the corporate rate around 25%. That top household rate, yes, will be 39.6. And the capital gains rate probably lands up more like 28%. If they got everything they wanted, you're taking about 10% off S&P earnings next year. That's a real number. The history books suggest, specifically when you raise the capital gains tax, the market does suffer in the 3 months that follow. Ultimately, not an obstruction to higher prices or a bull market. But I do think if the Biden administration got everything they wanted, the market would need to probably do some work at lower levels before resuming. What Rich suggested is just overall such a good economic climate. The market probably doesn't worry about it too much. In our dialogue, specific to your question, Kate, in our dialogue with hedge funds and large institutions, it's on the radar screen. If you look at parts of the market that essentially discreetly tease out, is the market pricing higher or lower capital gains? It's been a pretty modest response so far. And so I think the market's essentially saying it's a long runway. This infrastructure package is going to take some time to get done. This is not like the December package or the March package. In the end, it probably gets watered down. And again, it doesn't feel like a really sincere threat to stock prices today.
Got it. Yeah, and like you mentioned, Tony, it has been signaled for a little bit. You mentioned hedge funds. We had Gary Gensler testifying in front of Congress yesterday, talking about things like leverage. They mentioned Archegos, which I'm sure you can't comment on specifically, but I'd love to get your take on sort of what's going on with the amount of leverage being used, transparency when it comes to family offices. Do you have a take, Tony, on sort of what changes, if anything, after Archegos, and now that there's potentially more attention there by Gary Gensler and the SEC?
Sure. Kate, the industry lost something like $10 billion around that situation specifically. I'm just reading the same press that you are. And so anytime you have a magnitude of that loss, I think it's totally reasonable that you'll take a more sober approach to your business. And so I think every probably large bank is taking a look at its swaps business or its family office business and just saying, hey, have we kind of wired this the appropriate way? And if there's anything we missed that we learned a month ago, let's make sure we incorporate that. I don't think it results in a wholesale change to the industry. I think this was certainly an exceptional story in the context of the family offices that I know. I think the hedge fund industry, again, if you take a step back and you think about the past year, a period of totally extraordinary volatility, returns have been very, very good. There were very few closures, not a single blow up, if you will, that I can imagine. So I think both the buy side and the sell side, including obviously the banks, managed to move through COVID and the COVID period in very good stead. Again, the story's too significant, and $10 billion is too large a number for it not to inspire some introspection. But I don't think in the end we're going to talk about a radical revision to how people run their businesses now.
Rich, what's your takeaway from this scenario? What happened here? I mean, how should we think about that event? It was obviously, like Tony mentioned, massive, but is it significant in other ways in terms of changing things going forward?
Well, Kate, I'm miles away from that, in that I'm, although we're a macro firm, we're very old-fashioned long only. There aren't many of us who exist anymore, but that's us. And so I don't really know anything more than Tony knows. Let me change that. Tony knows a lot more about this topic than I ever will. I'll just say one thing that I've said for a really, really long time throughout my career. Regulation, whether it's financial regulation, the industry regulation, whatever regulation, governments are always reactive. They never want to try to kill a good thing or what's perceived to be a good thing. So regulation is always reactive. I think one has to always remember that. And it's if one is worried about these things, then one should worry about risk premia in the market. Maybe we're not being adequately compensated for some of these issues. But I think to say that the regulators should be in front of a lot of these, maybe they should. I mean, theoretically, maybe they should. Practically, they're never going to be. They're in any industry, not just financial sector, but if you think about whether it's food or whether it's transportation or anything, they're always going to be reactive.
Yeah, and one of those topics, and I know they've mentioned this too, in terms of something that has drawn a ton of attention, could potentially be reactive, but is SPACs. Sort of the future of fundraising. It seems to have cooled off a little bit. Rich, any thoughts on that whole phenomenon and the idea of sort of these shell corporations taking companies public?
I actually find it a little bit humorous, Kate, because it's not like Wall Street analysts have really nailed understanding companies that actually report data. Right? I mean, I don't think we've gotten rid of the positive and negative earnings surprise from industry analysts. So now we're going to someplace where there's absolutely no data and no transparency. But for some reason, people think that's a better investment. I actually think it's pretty funny. Realistically, Wall Street has a long history of these type of companies. I think in the 60s, they were simply called shell companies. I think that's actually what they were called. This is not the first time we've seen them. It won't be the last time. I think, the way to think about it and the way I think really sanely is what I just said. Analysts have enough trouble analyzing companies that have transparent, regulated, GAAP-related data. How in the world do you possibly understand a company that doesn't tell you anything? That to me is, you're taking a flyer. And I think people should think of it that way.
What about you, Tony? You probably hear a lot about SPACs and with your work at Goldman, but what's your take on, will this last? Is it a fad? What's your take on this whole phenomenon?
The progression and the sequencing has been really interesting because, again, the product in some way, shape, or form has been around a while. Once upon a time, it was kind of a product of last resort. And then at some point last year, that switch flipped to almost first resort. So we had an enormous amount of SPAC issuance in the second half of last year and the first quarter of this year. I think this shines off a bit. We've seen this. So the amount of companies doing a SPAC IPO, number of sponsors doing a SPAC IPO is down very considerably in Q2 versus Q1. I think in the end, it is a product which has merit. I do think it's not the worst thing in the world for retail investors who are essentially now getting to invest earlier in a company's life cycle. In other words, maybe it's essentially a Series B or a Series C in the private round, which is coming to market. And so for the right sponsor and the right underwriter, I think you're getting some essentially private equity-like growth into the hands of public equity market investors, which is a good thing. Now, I think in the end, it is governed by the availability of high-quality private assets. And so as we've seen the SPAC kind of boom or gold rush take place, the amount of companies that are out there to be bought, that hasn't necessarily grown at all. If anything, it's probably shrunk. And so I think we're probably headed for some kind of middle state where, again, high quality sponsors, high quality underwriters, finding PE or VC vetted assets. That will be a really good thing for end investors. Will we sustain the pace we saw at the end of last year or the start of this year? No, I don't think we will.
Yeah, I think you're right about the amount of late stage companies that are eligible for a SPAC. It doesn't feel like there's enough to go around. Another phenomenon, and we'll sort of pivot, I mentioned GameStop off the top. Tony, I'd love to get your take from sort of the hedge fund perspective. Is this making people nervous about publishing short positions? Nobody, wants to be the next Melvin Capital and have this army of traders on Reddit go after you. You know, how has that changed the way that people are thinking about publishing positions? And is there sort of a fear of this Reddit crowd?
I suspect, Kate, the game has changed. I think it changed very quickly, just given how, use earlier words, the magnitude of loss around that short squeeze in January was eye popping. Would be one way to characterize it. And you're talking about kind of a cohort of totally world class money managers who had a very bad couple of weeks at the office. And so I think at the very least there'll be changes to portfolio construction for a while. I think if I'm a fundamental long short manager and I need to have risk on the short side of my portfolio, I'll be doing a couple of different things. I'll probably be using more index product, more sector product, more ETFs, so slightly blunter instruments. Or if I'm going to have single name risk, I'll just have more names and smaller position size as opposed to kind of a well-disclosed concentrated short. I just don't think anyone reasonably want to take kind of the Reddit risk in the near term in running the exact same play all over again. Who knows 5 or 10 years from now how this all plays out, but I do think there'll be much more kind of cautiousness on sizing positions on the short side.
Rich, what were you thinking when you watched this whole GameStop saga going on?
So I'm a bit more critical than Tony on this one. I mean, I really view some of this as being very old-fashioned pump and dump type stuff on individual investors, where you talk up a stock and you get the stock going, and then all of a sudden, you sell your positions, and then you stop talking about it and the stock goes down. Used to be done in shady back offices. Now it's done on shady websites, not naming anyone in particular, but I'm sure that there's some boiler room websites out there trying to do pump and dump type stuff. So I don't view it as being a healthy phenomenon. I mentioned how regulation is always reactive. This is maybe one thing that I think we should be looking at very, very critically, because I don't think the typical, individual investor understands the concept of pump and dump, understands what can happen and the risk involved. And just as they couldn't understand when somebody was cold calling them, they certainly don't understand it when they're seeing information on a website.
And one of the things that really was borne out with this whole thing was the intersection of social media and stocks. And I think the idea, like you mentioned, pump and dumps, things, CEOs like Elon Musk tweeting about whether it's a cryptocurrency or his own stock. I mean, how are you thinking about sort of this new era that we're in terms of social media and investing? Do you think the SEC is going to take a closer look at that?
Oh, I think they definitely will through time. As I said, I think they're a little bit slow, but they will. Remember, the game used to be a long time ago that you had to be physically near the stock market so that your runners could go from the office to the stock market and you could place trades. And then it became more electronic, and the means of communications changed. And now the latest, the telephone changed some of that, and now we're up to websites and electronics. And so the means of communication always changes. It doesn't mean that the actual process of placing a trade and the thought process that goes in there changes that dramatically. Now, we could talk about algorithms and all that, and I understand that. But I'm just saying, in terms of for the individual investor and the way the individual investor thinks about it, I don't think the process has changed. The means of communication has changed, but the process really hasn't.
Got it. And Tony, I'd love to get your take on that side of it, social media and investing. And I think from the hedge fund side too, it seems like there are alternative data sources. People are sort of watching what the retail traders are doing, and you see instances of people sort of jumping on that momentum. I mean, what, if anything, does this social media era mean for the hedge funds, aside from sort of the short squeeze topic that we talked about?
So, Kate, I've been doing this for 22 years, which means when Dan and I were working together, which really was when I was working for Dan, because he hired me. It was 1999, and so it was kind of the very end of a very ferocious retail-led tech bubble. What was interesting was, in comparison, if you think about the years that followed the great financial crisis, if I think about years like 2010, 11, 12, ultimately it became a remarkably long-running, very high-quality bull market. It was marked by the total absence of retail participation. So we said, other than the corporate buyback dynamic, there's very few buyers. It's a very unromanticized bull market in a way. That really didn't change until last year. And so it was kind of last spring, last summer when we realized this is interesting. People are at home. There's an absence of things to do. There's an absence of stimuli, be it professional sports or otherwise. The government is mailing stimulus checks and it's become free to trade. And so that really kicked off this, again, what became a very ferocious wave of retail investment as well. I don't think that's all bad. So right now, for example, if you look at who owns the stock market, 90% of the stock market is owned by the top 10% of American households. I don't think that's an admirable statistic, right? And in a way, that 90% had missed out on so much of the wealth accumulation in the prior period I mentioned, in that kind of 2009 through 2019 period. So I think it's good that we're drawing in more investors. Ideally, it's this kind of buy and hold type investing, which is Rich knows is how you get rich in the stock market over time. Some of this is very speculative and very feverish, and you can see it in various and sundry ways. And so that, that part makes me worry a bit. It's a bit frothy. Some of these investors are uninformed. So usually those things don't end well. But I think from a longer term perspective, to the extent you're drawing in more market participants who will stay in the market, that's not a bad thing long term.
Yeah, and we have seen this rise of retail investing, like you mentioned, a ton of new entrants in the stock market, younger investors. I wonder, Rich, how you think about sort of investor protection, making sure people aren't losing massive amounts of money, doing the right research, but also, I mean, not to overuse this word, but democratizing finance, and companies like Robinhood have done that to an extreme. But the idea of allowing access, letting people trade, but also making sure it's safe. It just seems like such a fine line. How do you think about that?
Right. So Kate, I'm not picking on your word choice, but I always cringe at the word democratization, and the reason I do that is when I used to teach in the grad school at NYU, I used to say there's 5 characteristics of a bubble, and valuation is not one of them. And the thing is that the difference is that bubbles pervade society. You get speculation all over the place, but bubbles pervade society. And one of the common characteristics on the list that I used to put up all the time was democratization of the market. Everybody gets to play. That's a classic sign of a financial bubble. And so Tony's absolutely right that if we want people to build wealth through time, we want them to take part in the equity market. Absolutely. 100%, I agree with that. But I think that's a different story from, do we want people day trading? Day trading, the statistics show, are very close, a little bit better, but not meaningfully so. They're very close to flipping a coin. So when people start day trading, are they building wealth? I don't think any of us would say the way to build wealth is by flipping a coin. And so I think we want to be a little careful about the notion that Tony brought up, which again, I agree with 110%, 100% 2 minutes ago, now 110%, as I get caught up in my own analogies. But I think we want that to happen. That's critical to building wealth. It's critical to capital formation. That's very different from day trading for free. And I think I'm no fan of people day trading for free. I'm a huge fan of people building wealth, through investing and long-term time horizons and things like that.
And what about the argument? There's been, Robinhood in particular has been accused of gamifying stock markets, making it addictive in some cases. There's on one side, and Massachusetts regulators have really homed in on that. Then the other side is sort of the tech-focused Silicon Valley argument of, this is how they want to trade. They want to use their iPhone. They want it to be fun and engaging. And they say, okay, maybe that's the way that younger people will get sort of an entry point to investing. So, is there anything to that? Yeah,
I would say, Kate, I'm sorry to interrupt. I'm sorry. I think, look, there's the means of communication will change, and maybe in the future people will invest solely through their phones. I get that, and that's fine, but that's different from day trading. And one of the other questions I used to ask the MBA students when I taught was, what's the difference between the stock market and a horse race? And that's very important with the notion of the gamification of investing, because investing is not a horse race, right? You're not betting on Seabiscuit in the 7th. That's not what investing is all about. But that's what it's become. We even talk about it. We say, I'm going to make a bet on Amazon. I'm going to make a bet on something. People use that word. And that's not even right. And investing is not like placing a bet on a horse. It's like actually buying the horse, because people forget that when you buy shares in a company, you become a partial owner of the company. So think about what it's like is not Seabiscuit in the seventh. It's buying a horse, training it, racing it, having it winning purses and enough purses so you can put it out to stud, and hopefully you then get future revenue or future income from the results of buying the horse. That's what investing is like. It's not Seabiscuit in the seventh.
And Tony, I'd love to get your take on kind of how much attention you're paying to the retail trader. It seems like I mentioned alternative data before, but there are certain things that hedge funds in particular are watching, if especially they're trying to jump on a certain momentum trade, and it is more of the short-term trading. I mean, how are you thinking about sort of paying attention to these new market entrants? Because so far this year, they haven't gone away.
So I would say when you decompose who owns the U.S. equity market, hedge funds own about 3%. Now they comprise a larger share of daily volume, but the point is hedge funds actually own a very small slice of the pie. The single largest holder of the stock market is households, and that could be through direct holdings, that could be through mutual funds and ETFs. So it is the biggest, it's perhaps the largest financial muscle group on planet Earth. And so absolutely people keep an eye on things. It could be kind of just the broad kind of structural trends of money flow. So again, what characterized that period circa 2017, 18, 19 was very steady disinvestment from the equity market by the baby boomers who were taking mandatory enforced withdrawals from the 401k. Again, those dynamics have kind of been swamped by the younger generation joining with the plum. But the point is, people pay very close attention to kind of the direction of money flow as it relates to the retail investor. Yes, I agree with Rich, which is some of the run and gun message board gamification type stuff. That's not capital formation. That's typically not a recipe for long-term success. So I do think we should approach that with some air of circumspection, but we'll see where the regulators take it. I do also share the sentiment that typically regulators don't want to stand in front of things. I think the Fed specifically believed it was never really their job to manage or prevent asset bubbles. It was more typically to deal with the consequences of that. So we'll see where it goes, but it is a very hot story, and it's one that stands in stark contrast than if we're having this conversation 5 years ago.
Definitely. Yeah, absolutely. Well, we'll kind of move on from there to another hot topic, cryptocurrencies. I cover Bitcoin and a lot of these other high-flying cryptocurrencies for CNBC. There is a more serious global conversation, though, about what central banks are doing when it comes to cryptocurrencies. Rich, I'd love to get your take on sort of Bitcoin and that as an investment vehicle, how people should think about that, allocating any percentage to their portfolio. And then on the central bank side, what should they be taking that seriously? And does it make sense for the U.S. to try to catch up with China and launch a U.S. dollar digital currency?
Yeah. So Kate, I view them as kind of, your question is two separate issues almost. One is Bitcoin a good investment? And two, what's the future of cryptocurrencies? And so I think investors have a very tough time separating those two out. I think that, look, the future of cryptocurrencies, there's going to be some future. What it is, I don't think any of us really know. There's going to be some digital currency out there in some form, or multiple currencies out there in some form. I think we should probably expect that. However, that doesn't mean that Bitcoin today is a good investment. Let me give you an example of what I mean by that. Tony mentioned before the tech bubble, and 98, 99, 2000, and there were a lot of promises made and a lot of stories in 98, 99, 2000 about how technology was going to change your life over the next 10 or 20 years. Now, what's interesting is that a lot of those stories came true from after the tech bubble in 2000, 2010, everything. A lot of those stories came true, but the tech sector was the worst performing sector in the S&P 500 and gave you negative absolute returns from 2000 to 2010. The stories came true, the stocks didn't work. I don't think people are considering that with Bitcoin right now. Bitcoin and cryptocurrencies may have a very good future. I don't know. I'm not an expert. They may. That's a different story from, is Bitcoin at 55,000 or 60,000 a good investment? So I'm more optimistic on the notion that cryptocurrencies have a future, whatever form that is. I don't really know. Much more optimistic on that than I am on saying buy Bitcoin at 55 or 60,000. I think that's a loser's game.
So you're not, as far as questions directly about Bitcoin to your clients, you're telling people to avoid it at this price?
Oh yeah, absolutely, absolutely. I don't think I just look. I find it very interesting that people who have never traded pounds or yen or euros or yuan and have never taken a course in international trade and finance are suddenly experts in cryptocurrencies. I find that very interesting, and I think shows the amount of speculation.
Tony, what about you? Goldman, there were some headlines out today about Goldman starting to launch crypto trading, at least sort of on the private wealth side. What is your take on Bitcoin? And the same question to Rich, but what do you see as a value at this price, at least? And then we can sort of get into the broader topic of the future of crypto.
So I think Rich was correct to kind of disassociate the central bank question from everyone else. I think in my mind, essentially Warren Buffett, I think earlier in the game had said in various terms, Bitcoin's either rat poison or it's just a tool for speculation. I don't think it's rat poison. It might just be a tool for speculation. We'll see. I think as time marches on and it becomes more of a, I don't know if it's a currency, but I do think it's shown some value as a store of value and a mechanism for payments. You're kind of adding little slivers of credibility to it. So we'll see. I would say as a house, we've proceeded with caution. I think we've been open-minded. There has been demand by clients for us to provide services. So I think we've proceeded slowly. We're kind of edging our way into a few things like clearing futures, making NDF markets. And so, I'm open-minded to it. I'm drawn a little bit to the fact that people who I regard as world-class investors, either tech investors or just traditional macro investors, are involved. Now, these people might have been involved in tech stocks in 1999, so that's not a sure thing. But I'm drawn to it a little bit. I think the central bank question is different. I think that involves more kind of the world pushing back on the dollar supremacy. Look, the Chinese central bank has been first in the queue to kind of get this done. I don't think anyone should be confused. That ultimately traces back to their frustration with the dollar comprising something like 82% of global trade still. And so you have a geopolitical element to that. Again, my guess is that only advances the ball up the field. And we'll see. So I'd be lying if I told you I could explain crypto to my parents or to my children, but I'd say I'm kind of open-minded to where this all ends up.
And there is an argument, you mentioned dollar dominance, that a central bank digital currency could actually make the dollar even more dominant, that it would distribute this more easily to emerging markets. People in Venezuela and Brazil would rather have access to a dollar central bank currency than Bitcoin, for example. They actually don't really want to buy Bitcoin. Rich, any thoughts on what this could do in terms of the dollar dominance? Does that make any sense to you in terms of this being a good thing maybe for the dollar?
Well, I think Tony nailed it when he was talking about what's going on with, what percentage of global transactions are dollar denominated and should we assume dollar supremacy? I think Tony absolutely nailed it. The only thing I would put on top of that is to remember that our money growth here in the United States is far greater than that of any other developed economy right now. 25% money growth. The closest to us is likely Peru at like 30 or 31. Now, I'm not equating us with Peru. Don't misunderstand the point, but that may hasten this as well if we find that around whether it's Bitcoin or whether it's some other form of digital yuan or digital euro or something, I don't know. But Tony's point is that the dollar may lose market share. And I think that's something that people should be considering, regardless of whether you think there's going to be cryptos or not. That I think that's a reasonable risk that's out there right now. Again, I don't think anybody should use it as their baseline, but I think it's something that should be considered.
Got it. And Tony, you mentioned geopolitics. I'd love to get your take broadly on sort of what region you're the most focused on in terms of either risk or opportunity. And how are you thinking about sort of where we are in global politics as we sort of the new administration is in its almost halfway through its first year?
So I guess first principles, Kate, I'm a believer that typically economics trump geopolitics. Now, there can certainly be an interplay there at times, but I tend to find with professional investors, sometimes kind of the noise around geopolitical headlines can kind of distract from the mission at hand. And ultimately the day can be won by, or is won by, the direction of global growth and policy. That said, I think the whole ball game geopolitically now is U.S.-China. That friction, it's getting a little hotter every single day, it seems. We potentially have a flashpoint in the form of Taiwan. And so it feels like this will be kind of the core tension that probably defines the next decade or more. That said, I just saw that China reported a very good trade number, and 16% of that business is still done with the United States. And so we're still swapping, I think, for mutual benefit, plenty of goods and services every single day. But I would imagine that narrative will be with us for a long time. That can certainly be manifested in a given set of stocks or companies when they go on a given country's blacklist or ban list. So I think it's something that stock operators and financial markets will have to contend with. And certainly that will induce trading opportunities. So there's plenty to do trading the trade tariff headlines, for example, for well-informed macro investors. But I think in the end, it's more, ultimately the next 10 years will be governed by the direction of growth and policy, not geopolitical headlines.
What about you, Rich, as far as, I guess, risk and opportunity in global markets?
So I actually think that investors have become a bit too geographically myopic, if you will. 10 years ago or 11 years ago, when we actually started our firm, not to brag, but this is actually true. One of the reasons we started our firm was we thought we were entering one of the biggest bull markets of our careers. And we thought if you're going to start a firm, that's a good time to do it. But that was not the consensus point of view back then. When we started the firm, the story was if you wanted growth, whatever that was, define it however you want. If you wanted growth, you had to invest in emerging markets. And everybody was an expert on every emerging market you could name. And here we are now 10, 11 years later. And what does everybody say? Where else would you invest for growth other than the United States? Right? We've come 180 degrees, a complete change from 10, 11 years ago. And people have no idea what's really going on in a lot of these economies around the world. And so I think there's both not only equities, but also fixed income. There are opportunities outside the United States. I'll throw one out there, which I know nobody knows, and I will, full disclosure, we have positions in this, so I just want to make sure everybody knows. But we have positions in emerging market high yield debt. Now, most people, when they hear that, they clutch their chest and they say, "Oh my, that's so risky." But yet the default rate in emerging market high yield is lower than the default rate in U.S. high yield. And the fact that people don't know that shows how myopic they've become in an environment where everybody says, "Oh, where do you go for income?" And so if you believe that the dollar, going back to the dollar, is going to be stable, why wouldn't you look at things outside the United States? Now, if you think the dollar is going to appreciate mightily, clearly this doesn't work. But if you think there's going to be some stability to the dollar, then why wouldn't you look outside the United States, not only for equities, but for fixed income? And I just don't think people are looking at all.
Yeah, some news you can use. Well, we have a audience question here, and Tony, I'll let you take this one, and then Rich, I'd love to get your take on it, but it has to do with sort of U.S. opportunity. This is from Michael Moazampour. I hope I didn't butcher your last name there, but 6 tech companies, he says, FANG and Microsoft compose 24% of the market cap of the S&P. Given this significant proportion, do you consider the S&P still to be diversified? And do you consider the tech sector's size to be a potential risk for the markets? So Tony, I think that's a great question. What do you think about tech sector dominance and the risk to the market?
So I think the math is true, and I think it kind of illustrates the point that S&P 500 today is relatively top heavy and has a concentration in those top 5 names, which I think is as high or higher than at any point since, again, the tech bubble we reference again. And so I think that's something to be mindful of for sure. Now, I guess my reflex isn't one of that induces bearishness. And I say that because first of all, I think that has absolutely kind of been earned by those companies. And so, the S&P 500, it's a Darwinistic index by construction. It's driven by market cap. And I think whether it's Microsoft or Apple or Facebook or Amazon or Google, what they've built is, I think, very genuine in a way that, would be very different than if we're having this conversation, not that we necessarily would have known it, but if we're having this conversation in 1999. The other thing I'd say too about the index, and this is where S&P just is such a distinct asset from what you would find in other countries, it is still, I think, actually fairly balanced in this kind of question of secular growers, cyclicals, defensives, and it's done a remarkable job. You'll have a period of time in the market, like we've had in the past week, where tech stocks come off, but then all of a sudden banks come on. Banks come off, healthcare comes on, healthcare comes off, consumer discretionary. So it's got this balance in the big muscle groups, which has been remarkably good for investors. That's very different than if you look at like the Euro stocks, for example, in Europe, the FTSE in the UK, the Bovespa in Brazil. These are indices that tend to have very, very significant skews that are almost ironclad. And if you're in the wrong factor environment, that's very costly. The S&P has just been a world beater, and it's not even close. And so again, I think in the end, that is a credit to the companies themselves. I think you need to be mindful of this concentration risk, but for me, that's not a reason to run for the hills.
What about you, Rich? What do you think about sort of the tech dominance there?
Right. So Kate, I alluded to this before when I said there's kind of a seesaw going on in the stock market. So I think if the point of the question was to ask, is there a lot of risk in the market because it's concentrated in, the quarter of the market cap is concentrated in 5 or 6 or 7 companies? Well, then the question is there opportunity in the other 75%, right? If they're looking at 25%, is there opportunity in the other 75%? And we think there is. We think there is opportunity in the other 75%, whether you're looking at smaller capitalization stocks, smaller value stocks, ugly polluters, if I can say that without starting a whole fight in these days of ESG. There's lots of opportunities out there. And I think that's true. Look, I don't like to talk about individual names, but I realized this week that Tesla is now the 7th biggest market cap company in the world. It's like number 7 in the MSCI All Country World Index by market cap. To me, that seems a little nutty. To other people, it may seem fine, but my question is, where are they going to grow from number 7? What's going to happen here on top of that? Meanwhile, what about number 50? Does anybody even know who number 50 is, and what are the growth prospects for number 50? Maybe there's better growth prospects for number 50 in that list instead of number 7. I don't know, but I think that's what people should be looking for right now.
Yeah, and the last question for me, while we're talking about big tech, I mean, they had earnings last week. It seems like they're still growing like crazy. What about the antitrust risk? The idea that, they may not be able to do M&A like they used to. There's talk about breaking up big tech. Is that something you think about as a risk as we talk about this concentration? I mean, how do you think about how regulators are approaching big tech?
I would say, look, antitrust, I think, is a real issue. I don't want to talk about individual companies on that. I'm not an antitrust lawyer. I don't think that's probably the right thing to do. But I think there is an issue there. However, I think what people should realize is that antitrust and antitrust legislation and antitrust cases take years to play out. Years. I mean, a long time. Go back and look at AT&T and how long it took for that. Go back and look at the oil at Standard Oil and how long it took to break that up and everything. This is not something that's going to happen in the very near term. So I think, I don't know the specifics, and I'm not smart enough or have the expertise to talk about the specifics of antitrust for each company. But I would just say, I think there's an issue, but it's probably longer term.
And Tony, I'll give you the last word on that. What's your take on antitrust and the risk to big tech?
So similar to Rich, Kate, I don't have bona fides in antitrust law. I just have my degree from Colby in 3 weeks at college. And so I don't have real insight into the issues. What I would say is I come out in the same place though, which is I think in the end it's probably something which winds up being very long runway, induces headaches along the way. probably isn't something that results in a real significant game change for all these companies. If I go back to the point on US-China, my guess is at some point, actually, the move is you put your arms around your biggest, strongest global companies as opposed to attack them. That doesn't mean Europe can't sue us across border, but I think on net, it's probably something that doesn't stand in the way of earnings growth long term.
Got it. Yeah, it hasn't stood in the way of share prices, at least recently. Well, Rich and Tony, thank you so much. I'll send it back to Dan to wrap us up, but this is a lot of fun and appreciate you guys doing this.
Thanks.
Well, thank you, Kate. That hour really flew by. And from all of us at BC, thank you to our panelists for covering so many important topics in such a thoughtful discussion. You covered a lot of ground in an hour. And thank you to our audience for your insightful questions. We look forward to seeing many of you in person at next year's finance conference on campus in Chestnut Hill. As a reminder, we're recording this session and the 2 previous sessions will be available on the Carroll School's website. So again, thank you to our panelists, thank you to our audience, and that'll wrap the webinars for this year. Thank you.